Can you hear me? Can you hear me? Can you hear me? Good evening, everyone. If you can hear me, just comment that you can hear me so I can start. All right, let's proceed. So, good evening, everyone. Welcome to the free training for March and Happy New Month to you too. So, today we're going to talk about psychology, and in summary, we're going to talk about fear. So, I'm going to invite our guest speaker to come and share knowledge, value, and teach us a lot on fear. We're going to invite our guest speaker, Gideon. He's going to come up and speak to us so we'll learn today. So just get your notepad and just sit down and get your favorite snack because it's going to be nice. All right.
Hey everyone, hope you're all doing well. Can everyone hear me? Just make sure everyone can hear me. Uh, and can you guys see me? Okay. All right, cool. I think we should be good. Okay. So we're going to be talking about trading psychology today. So thanks, Annie, for the introduction. And what I want to focus on is basically what you're thinking prior to a trade, before taking a trade, whilst you analyzing the charts, and after, everything like that. So let's go. So when it comes to trading psychology, this is a very, very broad topic that people don't really take much consideration of, but it is something that is very, very important that a lot of traders get stuck with. All right, once they have whatever it can be, the strategy, risk management. But if your mindset, if your psychology is not right, basically everything else falls apart. You start breaking rules. So we're gonna go straight into it, okay? So we're gonna start with the mindset that you need to have uh, before analyzing your chart. And when we speak of this, it all depends on, or you, someone says they cannot hear me. I don't know who that is. Can everyone help me before I carry on? Okay, but we should be good. All right, yeah, we're good. So the mindset that you need to have before even starting to analyze the chart, and what we can say about that is you having to be in the right space of mind. So if you had something that was bothering you, or well, something that made you angry or emotionally, if we should say, that is not really the mindset that you need to have, or a state that you need to be in whilst analyzing the chart. So whatever way that you know to calm yourself down, because we're speaking about psychology, and psychology is basically different for each individual. So whatever you know that is able to calm you down, that is able to bring you to a state where you are thinking clearly, that is what you need to do before starting to analyze the charts. And this can be, we all different. It can be prayer, it can be meditation, whatever it is for you. Uh, that is what you need to do before starting to analyze. The next thing is you need to set up a target prior to your analysis. So something positive though, but just because you're setting off a positive target doesn't mean that once you're done with the analysis part and you're now looking for your setup and you finally enter a trade, that it's always going to work out. We all know it is not just chance, but you need to let your setup play out, and sometimes it does not, which is normal. So having that in your mind and not just expecting that the market will always give you what you want is going to prevent you from one revenge trading, to getting emotional, and three, obviously acting out in ways that you did not plan to, another way over risking. So losses are normal and they will happen, and so as winners also, they're also normal and they will happen. What we do is we tend to make the winners happen more than losses. Yeah, that is basically the goal that you need to have. So now the psychology that you need to have whilst you now analyzing the chart is, this is where you need to be a bit strict with yourself and be very, very truthful with yourself. And what do I mean by that is, if you're looking at the market, and let's just use an example, a bullish market. So we've been trending upwards, and for some reason you're feeling the need to sell, even though you can clearly see that price has been obviously going up. But because it's been going up the whole time, you're thinking it's probably time for a pullback, or price has to come back down now, and you start selling. That is not based off of whatever strategy you're using. That is not based off of um, the current movement in the market. That is based off of what you are thinking. And what you are thinking at that moment is not really what is the most important thing. Rather, what you analyze, what the charts are telling you, is what you should be focusing and going towards, because there is a mistake that a lot of us make, simply because with the example, because the market has been going up, you're thinking now, okay, it's time to sell because we've been going all the way up. But as they say, whatever goes up must come down. But yes, it will come down at the right time. But if the time hasn't come yet, then obviously you should know, okay, it's not yet time for me to be selling. Okay, so you gotta be very truthful with yourself because at the end of the day, you're in it to obviously make money, not to just fool around and throw money around because you are playing with people that are smarter than you. You're trading against obviously institutionals and banks. So you're trying to take money away from them and they're trying to take money away from you. So you gotta be very strict with what you do in the markets. Okay. Uh, the next point that I have for you guys is your risk management. You need to know what you are risking. You need to know what you are risking before you enter a trade, simply because that will prevent you from making reckless decisions. And by reckless decisions is you not being able to handle your losses. So if you are able to know exactly the amount you're risking prior to a trade, that means you've done your analysis, you know where your entry is, and most importantly, you know where your stop loss is. And from there, you can obviously calculate with just your entry and your stop loss how much you're willing to risk or how many pips you're going to use, right? For your lot size. So knowing exactly that, okay, in this trade I can lose $20, in this trade I can lose $100, and you are able to stomach that, meaning that if you lose the trade, you're not going to basically blow the bank. You're not going to lose everything you have. You still can be able, obviously, to survive and fight for another day for the next trade. So being able to stomach your loss will be helping or adding to what we call hmm, the word just slipped my mind, but it will be adding to your self-esteem. Yes, that is the right word. Your self-esteem and more confidence in your next trades, right? Because you know, okay, you have so and so win rate. This trade just happened to not work out. The next three trades obviously would work out because you have data that proves that this works. And if you have the data, then you know I don't need to risk everything on one trade. Rather, I can risk 5%, I can risk 2%, I can risk 1%, depending on what you are able to handle if you were to lose a trade. Okay. And for some reason, people neglect how important this is. And YOLO, if you know what YOLO means, you just go in a trade and you're like, hey, all or nothing. Though sometimes it works out, and that's when it really, really messes with your psychology, really, really messes with your trading plan, especially when you YOLO and it works out, because now you're gonna think, okay, it worked out this time, so obviously tomorrow I'm gonna do the same thing. I'm gonna YOLO again, and it's probably gonna work out. And you know what? It might, but when it doesn't, you lose everything. So you need to know that balance between you losing everything or you having an amount that you're willing to risk per trade, on having a pip range that you're willing to risk per trade. By pip range, I mean if you take a trade that is 20 pips stop loss, you keep that as your limit, and you say to yourself, okay, if there's a trade that is more than 20, let's say 30 pips, I will not take the trade simply because it will be too much for me to handle. Then in that case, you stay off the trade. So you know, okay, these are the trades I take, these are the trades I don't take, and your risk management will be basically adaptive to that point. Okay. So now we go to your psychology whilst you are obviously in the trade. And if you neglected all the previous points that I've given, this is going to be a very hard place for you because once you go in a trade, for some reason, most people go blank. Why? Because you probably entered impulsively and now you're thinking when the trade starts going, against you, you're now thinking, should I exit? Should I go BE? Should I take off my SL? Should I remove my SL? Should I extend my TP? Should I remove my TP? You start asking yourself all this whilst you're in the trade. And those thoughts at that moment is what would cause you to lose money simply because you cannot make a decision, and you need to be very precise in this game, right? So you need to be on point. You know, okay, this is where I'm getting out, this is where I'm getting in, right? This is how much I'm willing to lose in terms of pips. So if price gets to this place, I should be out of this trade. But now, once you're in the trade and you don't know what to do, that is a very serious problem. So you need to know exactly where you're going to get out and where you're going to get in. Okay. So you should not be thinking of any other thing that is outside of your plan right now, because you've done your analysis, you've seen where you're going to enter, you've calculated how much you're willing to lose, you know how much you're going to gain. That is all before even entering the trade. So once you enter the trade, this is where you let your trade play out, right? You let your analysis play out. You have the data, you've done all that you needed to do before, and whilst you entered the trade, the only reason you would want to touch it would be if you are a person that um, uses partial profits. You know, okay, when a trade gets to a certain level, I'm not going to open any charts right now, okay, but you know, when a trade gets to, let's say, 50% of your TP, if you're taking a 1-to-2, so 1-to-1, you know, okay, for me, based off of my data and what I've experienced in the market, I'm going to take out 50% of my profit at the 1-to-1 and move my stops to BE, and you let the rest run for your 1-to-2. You can do that. Or you're going to be a trader that takes the full 1-to-2, you do that. Or you're going to be a trader that just, you take the full 1-to-2, but when price gets to your 1-to-1, you move to BE. You can do that as long as it is part of your plan that you had before, not whilst you're in the trade. And that's when you start thinking, should I be in this trade? Did I take the right trade? Did I take the right setup? Oh no, it doesn't reach my confluences. Now that is a bad habit. But knowing when to get in or where to get in, where your stop loss should be and where your TP should be, that once you're in that trade, there's really no need to panic, but to let your trade to play out. So when it comes down to basically psychology as a whole, just to keep everything short and not too long, you need to trust your setup, you trust your strategy, because obviously you've spent time gathering the data, you've spent time gathering the information, you've spent time back testing, forward testing, and some people even just testing with live funds in the market. So why once in the trade now, there's the panic and everything. So you need to just trust your setup, your strategy, and obviously if you have good data in terms of win rates, or there are traders that use negative risk to reward, basically higher win rates around 80%, 75 to 80, and it works out. So in the long run, it should be good. So that is what I had for you guys um, for this session. If there is any questions, you guys can ask. But if there is not, then I'm gonna give it back to Annie. So do we have any questions? Let's see. Any questions, guys? Okay, don't look like it. Any,
Mm, okay. If in the absence of any questions, thank you very much for everything you said. So let me just summarize what I learned.
all right.
I jotted three things down. Let's the first one is let your setup play out. Or the second one is be strict with what you do in the market. That means have a definite plan. And the third one is risk what you are able to stomach, risk what you can afford to lose. All right, someone asked a question. So,
Oh yeah. What if after I analyze and it hits my SO? That is very normal. It can happen that you analyze, you do an analysis, and everything looks perfect, but for some reason, the trade does not go in your direction. So let's say you were buying, right? I'm gonna use that as an example. Let's say you were buying, everything is bullish, you see higher highs and higher lows, but for some reason you lose the trade. That could be not because your analysis was wrong, not because you were wrong, but it happens in the market that sometimes it won't just always work out. You cannot expect every single trade that you take to obviously go to your TP. There's gonna be some losses. That's why you have your risk. You know how much you're gonna risk. We just spoke about it before entering the trade. Because if you lose a trade and it's really affecting you, and it's let's say one trade or two trades that you've lost, because that's normal. It can happen that you lose two trades even in a row, and that is really affecting you, then you should look at your risk management because there's something wrong there. Okay. What does one do when you draw down? If what you're doing usually works out, then you don't need to change it. Drawdown is normal, it happens. uh, Drawdown in terms of when you're in the trade or your account balance. If you're in a trade and you draw down, you let your trade play out. Okay. If you in drawdown and it's your capital that's in drawdown, let's say you started with 1,000, you're now down 200, so your balance is now 800. That is normal. But if you know that you are in a losing streak, you would reduce your risk, and what you were risking you would reduce it until you see that the market conditions are now back to your favor. It's now favorable and is now back on your side. That's when you go back to risking your normal lot size or amounts that you risk. So yeah, sometimes it seems if yes, sometimes it does not always go in your direction. That's normal. That is normal. It's not every trade that is going to be a winner. But what we do is we make sure, or we at least try to make the majority of the trades to be winners that you can do with, what is it called? With your risk to reward, or with your win rate. If you have a higher win rate, obviously, if you have a 70% win rate, 30% of your trades will be losses. You see what I'm saying? So there's going to be the losses. But if the 70% can get you up, maybe in one trade, you can get back what you lost in the 30%, or in two trades, or in three trades. You see? So losses are normal. That's going to happen. How do you calculate the risk? I think Annie can respond to that. But simply, you have your entry, you have your SL. If your entry is, I'm talking about gold, your entry and your SL is 20 pips, there's a tool that you can use. It's very, very simple. My FX book, you can just calculate it there. Check out my FX book. me see. Okay, what do I want to do? Okay, when you get faked out, okay, you're in the right trade, you took your analysis, everything is fine, and you get wicked out. Maybe you placed your stop loss wrong. It's okay for you to re-enter the trade, provided only if the conditions are still good for you to enter that trade. So if you got wicked out, right, and let's say the candle didn't close below, just wicked out, basically taking out, I'm going to use the same example, buyers, taking out the buyers and then closed back within the range or closed back at your entry, whatever the reason might be. But if your conditions for that trade st- is still perfect, if the trade still meets your conditions, then you would re-enter the trade. I would still re-enter the same trade if it's still valid. But if it has been invalidated, meaning let's say the candle closed below, then you know, okay, I'm in the wrong side of the market and damn, I'm out. Okay. One more question and we call this a session. Okay. I think we're good. I think we're good, Annie.
All right. So, okay. As I was saying, and the last one was, is risk what you are able to stomach. So I jotted down some few things, and I'm sure that this one asked what is the best risk to reward ratio. Honestly, if I should answer this, it depends on your strategy.
Yeah.
But the safest is 1 to 2. That's the safest. Don't, if your strategy is telling you 1 to 5, 1 to 7, it depends on your patience. 1 to 1, 1 to 2 is actually the safest. Yes. So let's just call the session a wrap because we have spent 30 minutes and that was like the scheduled time for this whole session. All right, thank you. Thank guys for joining, and Gideon, thank you so much for giving us value.
No problem.
Um if you guys for to thank you guys for joining the call, you guys can actually message me so that you can have access to the book I just wrote. The book I just wrote, Mastering the Charts, a trader's guide to from chaos to profit. So you can message me and you have access to the book. So good night everybody. If you enjoyed this session, you can just type down what you learned in the comment section before we end the call. And you can actually tell Gideon thank you because he took his time to come and explain to us and teach us some things for free. So you guys can actually tell him thank you. I'll just give a minute for that before we end the stream. So then we start by saying thank you.
You, you're welcome,
You're
guys.
welcome, guys. Alright. Bye everybody. Good night.